Hi there, eToro. I've had comments and questions from a number of people saying that while they enjoy the videos that I put out weekly reviewing the market conditions for the week that's just gone, they would like a video that's a bit more specific to the portfolio. And so that's what we're going to take a look at today. One of the reasons that I don't put out such a review each week or even each month is that I find that I would be saying much of the same thing every single time. I'm a long-term investor, and particularly right now when there's very little that's changing in terms of the fundamentals of businesses, it's more about macro that's driving the market. I don't talk about the specifics of the portfolio. I understand why people want to hear about the portfolio and what I think about individual positions and companies now and again. And so I will try to do something like this once a quarter. On screen, you see the agenda of things that we'll be talking through today. I'm going to speed through some of them, otherwise we're not going to get to the meaty bits. I'm not going to read through the agenda, for example, because I'm sure you have read it already. In terms of my investment expectations, so whenever you invest in a particular asset or a fund, you should always make sure that you understand what that investment is about and adjust your expectations accordingly. So my expectations for my portfolio are that it will experience high volatility in the broader market. And this has been the case if you look through my returns all the way back to March 2015. And that means that on the lows, my portfolio might be a little bit more ugly than the rest of a very red market. But on the highs, it's generally a lot higher too. And ultimately, over a multi-year investment journey, I want my portfolio to be much higher than the broader market, and the cost there being me having to wear volatility through that journey. I'm not going to talk about the details of my investment strategy. I'm just going to touch on the key points. These are the 4 pillars of my investment strategy. I think it's enough to say that I am a long-term investor predominantly. Sometimes I might make some momentum trades. I'll rarely put a few hedges in place. When I decide what to invest in, understanding the macro context and political background is something that I do, but is definitely not the most important part of my investment. Instead, I'm looking at the individual companies. I'm looking at the numbers that they're putting out there month after month, year after year. I need to understand the business, its strategy, the competitors. I like to understand a lot about the leadership team. I believe a leadership team is a very important part of being successful in a business. And I like to have my investments, the companies that I own, exist within growing industries or industries that I think will be growing industries in the near-term future. In terms of the themes or categories of things that I'm invested at the moment, this is not a comprehensive view on screen, but I think that most things in my portfolio fall into these themes. So online commerce, it's still a big thing within developing nations, but in emerging markets, it is an enormous growth area. Some geographies that are seeing very high growth when it comes to online retail and online commerce are Latin America, Southeast Asia, and parts of Africa. Fintech kind of goes hand in hand with online commerce and online retail, but there are parts of fintech that are beyond that too. I think that we have the potential for a true cashless society, at least in developed nations in the next decade. And there are, once again, enormous growth markets within a number of emerging markets. I think we're going to see the death of cable or traditional TV, whatever your terminology is. Cable is still a huge part of the market. Streaming services have grown very rapidly. And I haven't checked the number for the US recently, but not too long ago, cable or traditional TV was still 50% of the market. That's a huge portion of the pie that still needs to be gobbled up by the streamers. There is an overlap between traditional television companies and some of the streamers, but some of them are completely separate. So Netflix is one example. There are still a large number of companies that are recovering from the damage caused by lockdowns. So companies such as hospitality or travel businesses were hammered, and some of them are carrying an enormous amount of debt. And the share price hasn't recovered because the business conditions haven't exactly been fantastic. The recovery there has taken a lot longer in some areas, and that's because a war broke out just as these types of businesses began to recover from the pain of the lockdowns. So I think through the next year or two, we'll see some of the biggest players in those arenas do very, very well. Business automation, I think, is another area where we're going to see enormous growth. I have worked with technology to achieve these kinds of ends for the past 2.5 decades. There's been an explosion of tools recently, and they've become more accessible in terms of price, and the features that they provide have become far richer. So particularly now, when a number of businesses are trying to cut their costs, automating various processes around their businesses, if the price point makes sense, is something that I think that they will still do. Ad tech is a very controversial area because of all the data that it deals with, but I believe that we're moving into the next generation of ad tech where privacy is taken a bit more seriously by the corporates, by the ad tech providers. Traditionally, it is an incredibly high margin business. Facebook, Google achieved very high levels of profit because of the high margins of these types of businesses. I think that those margins might be whittled away over time through the next decade or two, but I still think it is an enormous growth market, and there are some younger players today that I think will be the next generation of leaders. Global electrification is a very interesting area. So a large part of the world hasn't had electricity. They don't have electricity today, but that is changing. On top of this, as the world moves away from fossil fuels towards renewables, it means that more of the things that we use will use electricity instead to power whatever those devices might be. Electric vehicles being the obvious one here. Electrification has made the automobile industry a growth market. I don't think anyone saw that coming 15, 20 years ago. And I guess kind of related to global electrification is the energy picture. Attitudes towards energy are changing very, very rapidly. The energy crisis that we've been experiencing, I think, has accelerated part of the shift away from fossil fuels to renewables. Although it has also highlighted the fact that we need to lean on fossil fuels a little bit longer in a responsible way, hopefully, in order to achieve our vision of a world that operates far more on renewable energy. One of the major shifts in attitudes around energy has been the fact that nuclear energy is now being seen as something that is necessary in order for us to wean ourselves off of fossil fuels. So I expect nuclear energy and all of the things around nuclear energy, for example, uranium, to experience a boom through the next decade or two. Nuclear moves very, very slowly. There's a lot of legislation and bureaucracy around it, but I believe that once it starts rolling, there'll be lots of opportunities in that theme. Now, part of what makes my portfolio quite volatile is that I have a concentration of businesses within particular industries. So on screen you see the grouping of my holdings by industry. I've taken this from bullsheet.me, and you can see that the largest part of my portfolio sits across internet retail and packaged software. Although I own a number of companies within those industries, if a particular business within that industry slides in a big way, for example, we saw Amazon slide quite heavily last night and this morning, it tends to affect other companies within that industry. So it can be quite volatile. We should also note that it goes the other way too. So when these companies have been very successful, it tends to pull up other companies within those industries. I have roughly 30 odd holdings within my portfolio. I can't talk to each of them even in a summary kind of way, otherwise this video would take a few hours. I will try and put out more content that's a bit more in depth, specifically about companies when there's relevant news about them, so that you know my thinking, my rationale, my thesis behind those particular businesses. But right now, let's take a quick look at these 8 companies, which are some of my largest holdings. Amazon just released their earnings last night. They had a terrible quarter. It was to be expected. The world is experiencing an enormous slowdown, so people are buying less stuff. They're spending less money when it comes to expansions. So the AWS area of the business, which is still growing quite nicely, experienced something of a slowdown compared to quarters just gone. The thing to note is that one quarter does not make a business. Building a successful business happens over years and years, and Amazon has had many horrible quarters in its history. I'll bring up a diagram in a few minutes talking about the price action of Amazon from the beginning of time until now, and it'll demonstrate that. But Amazon continues to be a leader in a number of different areas, and they invested very heavily through the pandemic. And although that has hit the numbers in that period, it means that once the world returns to growth, I think Amazon will be well positioned to continue the explosive growth that it's seen through the past 2 decades. Disney is a company that is well diversified. It has parks, it has retail, it has a streaming media business, and it's demonstrated time and time again, even through a pandemic that saw a number of its businesses completely shut down, that it knows how to be successful in the long term. It evolves with the times. The release of Disney Plus was an enormous success that shows this behemoth knows how to continue growing. The share price today, I think, is incredibly cheap, and that continues to be a combination of a lockdown recovery play for me, as well as a company that is growing some parts of its business, high margin parts of its business, quite rapidly. Volkswagen, or Volkswagen as some people say it, is a fantastic brand, one of the largest automakers in the world. Its stock price was weighed down for a number of years by Dieselgate, but I think that it's kind of shrugged that off. It's done the right thing, and now its reputation has been repaired. On top of this, it's doing very well in the EV market, and I think it will continue to be one of the leaders when it comes to a global electric vehicle brands. Micron is a semiconductor business. It is one of two that leads its respective area. That is memory semiconductors. The share price there, like many things in the market at the moment, has taken an absolute hammering, but very little about the business has changed. Sure, the number of sales that they're making has decreased, and that goes along with economic cycle, but the management of this company is amazing. They are not going to lose their position as a market leader, and the market will turn eventually. And on top of this, there are tailwinds in the form of US investment within domestic companies that I think will benefit Micron quite well. Warner Brother Discovery is a company that's been formed from the merger of two companies, the two businesses there being Discovery and Warner Media, which was previously a part of AT&T. Now, prior to this merger, Discovery had proven that it knew how to build a streaming platform and was acquiring users at a rapid, crazy clip during the pandemic. Warner Media, on the other hand, has a number of incredible brands. So HBO is an example of one of those, but the capability, the platform, the delivery of those streaming services weren't fantastic when this company was under AT&T. Now, the potential here is that with the catalog of content that Warner Media has and the success that Discovery has made of its streaming service, we have a combined company that takes the best of both worlds, combining them, and the synergies there end up being greater than the sum of their parts. The risk there, and the reason somewhat for the depressed share price, is that this joint company has inherited a lot of debt from AT&T. So the market is waiting to see if the combined entity is able to get rid of that debt at a reasonable clip. Canadian Solar is a solar company that I talk about a lot. Unfortunately, because it has some deep ties to China, the share price tends to be affected by Chinese sentiment. It is, however, a global company headquartered in Canada. The US is an enormous market for it. And fairly recently, there were tariffs on solar imports from Canada to the US that those have been lifted. So I think this company will continue to do well in a world where green energy is being embraced. Tariffs have been lifted with one of its key markets, and the company has shown that it can successfully operate through the past 2 decades. Mercado Libre is one of my favorite companies. It operates in Latin America. It's headquartered in Argentina, but its largest market is Brazil. It's sometimes called the Amazon of South America, although it doesn't really have the AWS component, but it does have a fintech part of its business that's kind of similar to the Ant Group that used to be a part of Alibaba. Do yourself a favor and look at the last few earnings reports of Mercado Libre. This is a company that's, I think they're 2 decades old now. They keep on expanding geographically, but also their product set. Some of those new products are growing incredibly rapidly, and they tend to be higher margin products than you see within e-commerce and retail. Another interesting element is that a lot of the economies that it operates within have done okay through the past 6 months or 9 months. And so this is one of my primary candidates for building an even bigger position once it becomes obvious that the market has bottomed. And finally, Block. I prefer the name it used to have, Square. This is a company that is down more than 80% from its all-time highs. I think that it probably overshot on the way up, and now it is undershot on the way down. It's a company that I thought I would never see the share price under $80 again, and now it's somewhere in the $60 range. It was co-founded by Jack Dorsey, so the guy that founded Twitter, and in a relatively short amount of time, it captured an enormous part of the point of sale market as well as the e-wallet market. It is incredibly exposed to a downturn, an economic downturn, because it's dealing with payments. So there's a very direct correlation. If people are spending less, then it's probably going to make less money. But it's also very hard to ignore the incredible growth that this company saw over a number of years leading up to this year. So unfortunately, its fortunes are tied to the economic cycle quite tightly, but that just means that when the next boom comes along, this is one of the companies that will be the most direct beneficiaries. Some positions are down quite a lot. And if this is the first time that you are going through such a big reset in the stock market and in the economy, it's a very, very painful process. I've been through many of them, and it's still a painful process for me. But if you pick your favorite stock that's more than a couple of decades old and you look back through history, you'll see that even though this is rare, it's not that unusual. even amongst the best investments that you could possibly have made, and there's some hindsight bias here, of course, you will see that drawdowns of over 50% are things that happen a few times every decade. Now, the chart in the background here is of Amazon. It doesn't have the most recent price action, of course. You might have noticed that. But it has everything from, I think, a week or two ago, going back to the time that the stock listed. I'm kind of ignoring the dot-com boom and bust because that was a very crazy time in history, crazier even than what we're experiencing at the moment. But then if I read the numbers that I've just pulled out on screen, there were drawdowns of 69%, 58%, 66%, 33%, 29%, 37%, all within this period. Along the bottom of the screen, I've got the annual EPS, by the way, that was declared for the company over the same period. And if you're able to see it, there are periods where EPS on an annual basis is negative, sometimes for a few years in a row. And then there are other times when the EPS grows enormously through subsequent years. So you might have been an investor during one of these periods where there was an enormous drawdown. The second one on the left is a 58% drawdown that happened over a number of years. And EPS growth turned negative on an annual basis. You might have been tempted to sell out of the stock. In fact, I bet you could have made a reasonable case why you might be selling out of the stock. However, understanding Amazon and how it works, it tends to go through a capex cycle. It spends a few years investing in itself, what seems to be overspending in itself, and then it enjoys a few years beyond that, where there's enormous growth in terms of profit and revenue because of those multi-year investments. Building companies takes years and years to be successful. What this means is that if you were experienced and you understood the business at that point in time and you had bought into it roughly around 2004, you would have gone through a number of painful drawdowns, some of them quite long. But if you'd managed to hold until today, even with a big drawdown today, your return from the top of 2004 until today would have been in the region of 3,200%. Now, within any portfolio, you're going to have a few bum stocks. Something goes wrong, you were wrong, or there's just something that changed the situation entirely that means that a company doesn't do as well as you'd expected. What we are trying to do as investors is have more companies that are doing very well than companies that are doing badly. And that's all you need in order to have a return that is better than the broader market. I did want to touch again on my lifetime goal. So I would like to have an investment career where I've achieved a compound annual growth rate of about 25%. I know that a number of people will be chuckling because my past 2 years on eToro haven't been fantastic, but my CAGR is still around the 22%, maybe slightly under the 22% mark on eToro, and that means that I need to exceed a 25% return for the next few years to bring it back up. Some of the biggest things that might cause me to change my portfolio composition at the moment are China's stance towards COVID zero. I don't see how they return to growth until they've changed their policy or at least watered down their policy somewhat. Stopping and starting major parts of your country in order to deal with coronavirus is going to be just too disruptive. It's going to erode everyone's confidence in that economy. So I'm trying to decide if I dial back some of my investment there. However, there are companies in my portfolio. I know Douyu is a company that people don't like me diamond handsing onto. But if you look at the details of Douyu, which is a kind of a streaming company in the same vein as Twitch, the book value of that company is 3 times the share price. So if that company was sold just for the things, the tangible things that it owns today, and all the money returned to investors, you would get 3 times the value of the share price today. And so while I'm tempted to dial back some of my Chinese exposure, it is quite small, and I'm tempted to see what happens through the next quarter to see if after the National Congress, the approach to COVID zero gets changed, i.e. watered down somewhat, because they've had the big political event, they've banged their chests about the success, but now the economic realities might mean that they start changing the way they carry this out somehow. I do think that there's one more drop left in the market. We will see probably the last of the 2 major interest rate hikes within the US this year, maybe one more towards the beginning of next year. And over the past week, we've seen central banks in a number of other regions not exactly turning dovish, but they're starting to say we can't continue to hiking our rates like this. The thing that I think might cause one more drop in the market, or at least keep it range bound for another quarter, is the fact that the economic realities are now starting to catch up with the stock market. The number of layoffs are increasing. People are spending a hell of a lot less money. And a lot of people, I think just about everyone, is feeling a little bit poorer. And finally, I'd like to add maybe 5 to 6% cash to my portfolio on the 1st of December. I'll put out a separate video and content about that. The reason is because I think that we are pretty close to this bear market bottom. We're definitely closer to the end of it than to the beginning of it. And I'm really very excited about the returns that we're going to see over the next few years. As an aside, I wanted to talk about something very specific. I get a lot of questions and comments about this. One of the most common misconceptions in investing, not necessarily just new investors, is that selling at a loss is a bad thing to do. And there are a few reasons why you might want to do this. But the emotional response is that the deeper the loss, the stronger the desire that an investor has to not sell, to hang on until something changes. But in some cases, that's not the best thing to do. Now, one of the reasons to sell at a loss is because there's something else that could provide a better return. And so I provided an example on the right of how that might work. So you bought a stock for $100, anticipating it can go up by 20%. So you want to sell when it hits $120. However, stock market collapse happens, your investment drops by 30%, it's now worth $70. You still think it's worth $120 in the long run, so you hold on to it. At the same time, you see that another company, XYZ, has also fallen, and your model suggests that if you invested there, you could make 95% from current levels. So what this means, and you can probably see where this is going, if you were to sell your current investment at minus 30%, taking a 30% loss, and move the remainder into the other stock, your potential return is then $136.50 versus your original anticipated return of $120. So the potential is to make a bigger return by selling your current holding at a loss and moving the money elsewhere. Now, in markets like we're in today, huge, deep, long bear markets, you get more opportunities like this than you get typically. So I will try to put out communication when I have done something like this to explain it and remind people about why I'm doing it. But this is just something to bear in mind. Okay, and in terms of closing remarks, so this is the same final slide that I had in my quarterly copier update. On the right are just some stats, just to remind you, and that I used to remind myself about bull markets and bear markets. Bear markets feel horrible, but they're a necessary evil to reset the market, and bull runs tend to be much larger and run for much longer. This particular bear market has had its own special flavor. It's set its own few records. It's worn out of a lot of investors, and bear markets generally do, and these people exit the market entirely, usually at an enormous loss. To be a successful investor, you need to be very patient. You need to have an iron stomach, and you probably need to go through at least one of these before you recognize the way that you respond. Like I said on the previous slide, I think that we are probably closer towards the end of this bear market than the beginning, more than halfway through it. And I think a lot of the macro data that has been driving this bear market, together with the responses by central banks, is about to change in the next quarter or two. The funny thing is that during bull runs, people are always waiting for the prices to drop. They really want that opportunity of things being cheaper, to pour money into the market and to experience an incredible return. And that's exactly the kind of opportunity that the market is giving us right now. Okay, that's it. I hope you found that useful. I'll try to do this quarterly, and have a great weekend. Goodbye.